So everyone knows our Roman numerals. XXV stands for 25. And so it was supposed to be 25 people in the room, and then I just started inviting people, and I couldn't stop. First of all, I am so grateful every one of you are here. And I thought Joel had the good ask. The ask is that this is a Socratic process here, so work with your neighbors, interrupt, ask questions. I had two agendas. One is I'm going to talk a minute at the end of my pitch here about what I'm doing next, and I called you into this room, everyone in the room, because I thought you could help. And so I'll tell you what I'm working on next. We're going to hold that to the end of my presentation. But the day, Henry, is there a clicker? Oh, thank you, sir. You're one step ahead. Here's a day, and I'm going to correct Joel. I thought about this for a long time. I just couldn't figure out who, when, and where. So we're going to have a panel with my favorite group, because there's a lot of investors in the room, some incredible investors and some thought-provoking about how they make decisions. Patrick Kent, we worked together for about a decade. We're friends for now 25 years. Patrick's going to talk about technicals and how they help you make decisions. Longtime friend Dr. Evian Gordon is going to talk about how the brain actually works. He's been studying this for 40 years, applied neuroscience. We get to eat. We'll have a panel talking about AI, and I've coached the team talking about AI, that you can't talk about the future. I only want you to talk about how you're using AI today, and so that'll be interesting for me. Dan Rasmussen has written a really cool book here called The Humble Investor. It is the best investment book I've read in 15 years, and I stopped reading them because I couldn't stand them. So thank you for coming, Dan. John Burns has now become a friend. We were both clients of Tom Brady. John ends up running TB12 for a few years, and he's going to talk about how to link the behavioral side of health and wellness and then what he's learned as an investor. You already met Joel. I want to talk about shared fictions, right? And we're going to describe what I mean by shared fictions and, why humans are crummy investors. We're good at a lot of things as humans, but we weren't designed to be investors. And everyone's seen Star Trek? Alicia, you've seen Star Trek, right? I watched a lot of Star Trek, but in this scene, Spock has just left a planet under which they were doomed to die, and they're trying to get out in their little tiny spaceship. They've got 7 people on the spaceship, but they don't have enough fuel for 7 people, and so they're bickering back and forth about how to get out. They actually end up being safe. And then this is the dialogue afterwards with Kirk teasing his Spock-like character.
Tell you something I don't understand about all this new expression. We do logically, of course. When you jettison fuel with 90 euros, virtually no chance of seeing it, you did it anyhow. That would seem to me to be an act of desperation.
Right, correct, yeah.
Now, we all know, and I'm sure, desperation is a highly emotional state of mind. How does your well-known logic explain that?
Quite simply, Captain. I examined the problem from all angles, and it was plainly hopeless. Logic informed me that, under the circumstances, the only possible action would have to be one of desperation. Logical decision, logically arriving.
See, you mean you reasoned that it was time for an emotional outburst?
Well, I wouldn't put it in exactly those terms, Captain, but those are essentially the facts.
You're not going to admit that for the first time in your life, you committed a purely human, emotional act?
No, sir.
What I liked about that, I watched it when I was an engineer, and we would watch it, right after dinner every single night, except for, I suppose, Friday night, when the few times we would chase girls. But I think what he's getting at, and we'll talk more about this, is that great investors, great aviators at that time, think probabilistically. So I put up these 5 questions, and I'm trying to trick you here. So don't get angry with it. The first one is, what are the odds of getting injured driving 60 miles? Some of you drove 60 miles to come here. The next question is, what are the odds of getting injured in a 1,000-mile plane ride? Some of you actually were on the plane for 4,000 miles. I'm so grateful that you came. Getting hit by lightning in a calendar year. If you're swimming on Cape Cod in a single day where the odds of getting hit by a shark and then a scratch ticket, odds of winning $1,000. Anyone want to wager a guess at what is the most likely on that group?
Is the shark around Truro?
There we go, sharks around Truro. Yep, sharks around Truro. Just throw a guess out. The car, you guys want to say the cars, that's actually not bad, right? So their chances, driving 60 miles getting hurt, 1 in 22,000. Airplane, 1 in 14, which was actually more than I wanted to hear, but that is 1,000 miles. So Evian, for that, like, you know, I don't know, you were 1 in 5,000 chance of getting hurt on that plane. That probably includes small planes too, but you were not in a small plane, I assume. Lightning in a calendar year, that's more than I thought, actually, 1 in a million. Now, I did my own math to come to this shark thing, but it was 1 in 25 million, all right? And yet, when I'm on the beach on Cape Cod with people, like, they're sometimes worried. And my favorite day on Cape Cod, not my favorite, but my weirdest day on Cape Cod is Memorial Day. It's 6 months after the fatal shark attack on Cape Cod. And I've done all the odds, I've done the math. There really aren't many sharks Memorial Day. They tend to come right after Labor Day. And so I'm on this desolate beach, and there's 2 other people on the beach. And I walk in and I go surfing. And these 2 50-year-old women come running up the beach. There's sharks here, there's sharks here. And I said, you know, probabilistically, no, there's not. I understand. Well, but she was petrified for me. And that's a very human response, right? And so we want to talk about trying to take the humanness and convert it to financial decision making. And I'm going to walk through, you know, the 5 ways I kind of think about it, my own checklist, that I've just copied from others, frankly. None of this is original, so I'll show the people I copied it from. The first and most important thing as an investor, and this is even as a human, is you need to start with you're a human. All right? You are not a Neanderthal. And this guy right here put a capstone on it. This is Yuval Harari's. He wrote the book Sapiens. The book has been widely criticized. So don't worry about the entirety of the book. I actually loved it because he told a lot of shared fictions, stories. But the most important thing he said was that the reason that Homo sapiens beat out the Neanderthals were smarter, they had more logic, they were stronger, they could withstand cold better, and yet the Homo sapiens won. And they did it over time. Why? Because they believed in shared stories. They believed if they collectively worked together, maybe they could do a little better. Right? And he put it well in this quote. And I'm not sure if the print's too small for people in the back, but humans rose to dominance through storytelling. So think about that. We are one of the only really genetic species in the world that believes in stories more than the facts that are present in front of us. It allowed us to survive. So what is a shared fiction? You know, a shared fiction could be a lot of things. Sorry, I put on some things people are going to be mad about. Right? Well, money's an illusion. The fact that we believe this piece of paper is worth something is crazy. It's a shared fiction. Might it always be worth something? I don't know. If you study the ascent of money, you'll see that the currencies have changed every couple thousand years. So it's a shared fiction that we believe in this. And I put up religion on there. You can believe whatever you want, right? But I thought going back to Greek mythology was a good way that we could all agree that was a shared fiction that didn't end up being true. Right? We believed that the only way to influence weather was by killing our own kids and sacrificing them to the gods. Now you would look at that and you would go, oh my God, that's a story. It's not believable. But everyone believed it, or enough people believed it that they would actually do this. So as humans, we believe in this. Let me poke at some shared fictions in the stock market. And I thought Dan put it well in his book. He said, you know, the biggest damage that the market can do is when everyone believes something to be true, I'm quoting you, but it's not actually as true as we think, right? And the one that should jump out to you is the second one. For anyone who was an everyday investor, everyone knew we had a housing crisis brewing in Las Vegas and Florida. That wasn't a surprise to the market. The consensus told for almost 40 years was the U.S. can never have a national housing crisis. And that meant the banks were fine, right? Because they were lending in Texas, but Boston was going to be fine. And the truth of the matter is, we were systematically corrected and we had the first national housing crisis. Now, this next slide, before I put it up, is going to anger people in the room. And I'm not saying I'm right. I'm saying these are possible shared fictions in the stock market today. Right? I've got Spock saying, U.S. central banks can set whatever interest rate. That's clearly, it clearly probably is working now. I don't know that it works forever. But, AI data centers are a sound investment or a very high return on capital investment. That is very unlikely to be true. But yet, vast majorities of the market do believe that. Adam, you meet with a lot of investors. That sounds about right. And these are air conditioners with semiconductor chips that are all the same. This is more like an airplane to me than a proprietary product. Now, the one I hear, Paul's in the back of the room, we work together. What we hear a lot from clients is this simple 60-40 is a risk mitigating approach. And so here's just the data on 60-40, right? So what someone did is they went back 120 years and they said, what are the correlation between stocks and bonds? Common sense and logic, Spock-like, would say stocks and bonds are correlated. And 60-40 isn't really a great idea if you're trying to reduce risk. You can see, though, that there were periods of times in which they were anti-correlated, which is people are pitching now. Well, the only time 60-40 works is when you're under yield curve control, right? In the late 50s, we had too much debt in the United States post the war, and we fixed interest rates. Well, now we have too much debt, and we're trying to fix interest rates again. So it's a shared fiction. It's not necessarily true. All right, so the second thing you need to understand as a human, and Evian could talk about this for I don't know, Evian, we've had hundreds of hours of conversations on this. He will talk later in the day, but we all have bias. And no one was better at highlighting this than the guy on my right here. And at one point, I used to have some more hair. And I said, what are you trying to do? And he's like, we're simply trying to be greedy when everyone else is fearful. And I'm like, that is completely useless. It doesn't tell me what to do, right? It's like me going to my kid. Most of you guys know my kids all play basketball. And my kid saying, I just want to make a bunch of three-point shots, right? It doesn't tell you what to do and how to do it. And so as many people are trying to follow these investors, I think it's flawed. I do think it's flawed not getting to the next level. And so what I did, this is for myself, but I looked at all the biases he talks about, and I wrote it down into 4 statements you should know about me or probably about yourself. The first is, I'm a type 1 thinker. We all are. We're reflexive, right? We see Dave walk in the room with bald head and, kind of goofy looking, and we have a pinch about him in 2 seconds before I've opened my mouth. That's instinctive. Those are things that kept us safe, right? Instinctively, when the whole crowd was running one direction because there was a bunch of buffalo coming at it, you didn't just sit there and go, what's going on? You just started running. That's how we were designed. The second thing is, this is probably my worst problem when I invest, is I remember all my losses more than my wins, right? And there's some math that supports that, but it almost can freeze you from decisions, right? When the market's going down and the stock you love was at 20 times earnings and now it's at 10 and you can't do anything because you're reading the press. This is not one true of me, but this is true of a lot of people I know. Those of you, there's a few of you that work with me on my team for years, and we used to do this drill where we practiced saying we were wrong. And that doesn't come naturally to us. We do all sorts of things to defend our opinion. We look for the research that supports our view. You know that, Tom, as a reporter. You can spend all day long trying to find the view that supports you. And you need to understand that, because when you own an investment or you've made a decision, you are going to surround yourself with the views that support your view more likely. So seeking that devil's advocate and the contrarian is really important. The last one is obvious to a point, and I like this picture better as a way to make the point. All right, so it's a sunny day. We're walking down the streets, and you see this line in front of this restaurant. Guaranteed, everyone in this room, if you've never been in that restaurant, you're going to ask people what they're in line for, right? Because you're curious, right? And you want to know what the crowd is doing. Makes sense, right? Let's say we went to a new town, right? And you research the heck out of the restaurants, the chef, and the food. You've done all the Spock-like work up front. But yet you come to the restaurant and there's no one sitting there. You're going to be like, I wonder if I picked the wrong restaurant, even if you had done all that work. Well, that's okay, right? But that's a bad way to invest, right? It may be a great way to pick your restaurants, but if your human nature, everyone's human nature is they want to follow crowds, that could be a problem. All right, so to summarize, all humans have these biases. You need to understand what they are, but I don't think that's enough. The second point is this concept of producing your own plan. And does anyone know who the guy in the upper left is besides Joel? This is Atul Gawande. He's saved more lives in healthcare than any person on the planet. And all he said is, when you go in for a surgery, your surgeons make mistakes every once in a while. Why don't you just have a simple checklist, right? Why don't you, if anyone's seen anyone, they write on the arm they're going to do surgery on, and they say ACL on it so they don't do the wrong surgery on the wrong arm, right? Simple stuff like that. Now, here's what he said about it. Checklists should be done by the user, the person doing said checklist. It shouldn't be done by corporate. It should be done by the person who actually does it every day. So if John, your analyst team that's modeling, private equity, they should build their own checklist on what the things they are checking. Now, I think Mike Tyson understood human nature even better. He said that your cortisol response after you get hit completely changes and you're completely irrational. That may be fine as a human when you're in a fight, but when a stock working against you, an investment's working against you, your net worth is going down, cortisol is responding, you're not making good decisions. You need to understand that. Now, like or hate this guy, he has incredible returns. Here's his plan. Now, this works because Carl Icahn, I've met him, he is a mean son of a bitch, all right? He doesn't have any friends, but that works for him. You can see the checklist. I won't, but you notice he even wrote, have a plan and follow it. Now, this guy is more likable, Warren Buffett, like he knows how to market himself, right, even in this picture. And this checklist, I took, there's literally been 100,000 pages written about him. I had GPT read them, and this is what they came up with. You notice in here, use checklists. Keep things simple so you can understand. Okay, the rest of the things you've probably heard talked about at length. Now, I built a checklist for myself that I'm going to show to you next. I don't want anyone to write down what I did. All right? That's not important. I have different skill sets. I'm weird in my own ways. I have different types of advisors than you. But I want to create a plan that works for myself. And so here are the questions I ask myself. All right? What do I believe in? Right? It could be that I believe in doing good with my investments. That's a possibility too. Right? What are the biases I naturally bring into it? I actually like, as crazy as I like doing the opposite of everyone else. So I don't tend to follow the craze. That's actually a problem, right? Sometimes I lean in when I shouldn't. Adam's encouraged me to think differently about that. Thank you, Mr. Parker. What are my goals, right? For me, it's to provide safety and security for my family first and foremost. I don't need to keep up with the Joneses, and I need to remember when the Joneses are up 55% because they bought a meme stock, that's not me. And then what is it that I'm unique and good at, okay? And I think I'm good at a couple of things, right? So I wrote these down. The first three are like motherhood and Apple. Incentives dictate behavior. Charlie Munger did a long video at Harvard, and he starts the meeting with saying incentives dictate behavior, and then he goes very amplified, and he said, the only thing I didn't realize in my career is incentives dictate behavior more than I thought. Price matters most. I'm a value guy. Cash on cash returns is paramount. One of the things that I've learned working with Paul Karger is we need to be explicit about the things that work and what doesn't work, but more importantly, we need to understand what we're not good at. And then we need to turn that work over to pros, right? So Patrick's going to talk about technical or momentum investing. It's not something I have a stomach for or could do. I need to hire a pro to do that. I think it's a worthwhile asset to own. Stay humble, write the plan down in pencil, as they all suggested. So one of the things, and this is a small commercial for the work that Joel showed me, 17 odd years ago? And So this is Amazon. And you can see the quote. If you can't read it, I read a bunch of sell-side comments from 2005. You know what the number one comment 2005 was? Amazon doesn't make a lot of money. And the reason they believe that is because if you look at that little tiny orange bar down there, that is the ROA that if you quickly did the math, you got to. And it was no better than Macy's, to be honest, at that point. It was, low to mid-single digits. Joel and his team in Manila make 125 adjustments. And then they come up with a different number for what the cash-on-cash returns are of said business. And you could see Amazon, it was off the charts. It was over 40%. It was 254%. Now, so the observation would be here, look at the stories that were told by the sell side because they were anchoring on one number or one margin level, right? They had negative working capital. That's why the returns are so high. Now, there's a second observation I would have from the chart, which is about the future, and I read this on Twitter all the time. While Walmart is, or Walmart or Costco trade for higher multiples than Amazon does, Amazon's a buy. But now if I look at this trend, if I look at Joel's work, right, you can see we're at 250, and now the company's down in the mid-teens. This is a pretty average business on return on invested capital at this point. Why? Because we're investing in data centers. It's not the same as stealing profits from Barnes & Noble, right, who had physical bookstores. Okay, so you need this plan, follow it, understand it, but there's another activity you need to understand, which is this concept of good judgment. This guy, this is Phil Tetlock. What he would say is the number one thing great investors do is they ask a lot of questions, all right? So now I'm teasing you guys, please ask more questions. But Phil Tetlock ran a study over 25 years. 25,000 people, half of them Department of Defense, research type people that knew a lot about world events, and half of them just random people from the street who signed up for his contest. And so he studied behaviors and how people make decisions. And first of all, the Department of Defense kept calling him back. You know why they kept calling him back? Because people who knew nothing about world affairs, had no CIA intelligence, were better forecasters than the experts, right? And that's because the experts who knew a lot about China, Taiwan, conflict, we were just talking about that with John and I were just talking about that. Well, they came in with their own bias, right? But rather these outside thinkers could make better decisions from them. And he wrote a book on it, but what he found with these great forecasters studying 25,000 people over 25 years is they talked in terms, like two things I thought jumped out. Is first of all, they knew when to bet. Sounds a lot like a good gambler, right? They knew when the odds were in, but when the odds were in their favor, they went all in that they were right or wrong. And then the second is they always talked in probabilities, not possibilities. So here are the takeaways. And it's not easy to do, but these are the characteristics and traits when you're making good decisions. First, this concept, Warren and Charlie talk about it all the time, is kind of know what you know, right? There's an element to what you don't know. You may not be great at everything. Your advisors might not be great at everything. Well, breaking down to manageable bites, what this means to me is, can you understand the core investment idea or concept or belief you have? Can you break it down into smaller steps? And if you can, there's a chance you could follow the plan. If it ends up being incredibly tortured and logic prone, you're probably not going to be able to follow it. This one is the one we all know so much about, and we tend to do it very poorly. All right, so what do I mean by this? If you're going to make any decision, whether it's an algorithm that's advising you, where it's Joel's tool that I'm using almost every day, half a dozen times a day, or it is your investment bank, or it's your analyst that's working with you, Kyle, on the royalties, you really need to think about what are their inherent biases and goals. And I, this is a, what movie is this from? What show is this from? Sorry. What's up? Gomer, there you go. And I clipped it so long ago I forgot. And here he's giving me, he's the stooge at the desk, right? Or at the poker table. If you don't know who the patsy is, it's probably you. But I think I think what we want to do as we're getting through this process and approach is think about it in these three things. And the most important is the top one. Everyone talks about the incentives of their financial advisor. Everyone understands. The first question we get at Twin Focus is, what are your fees? I'm like, all right, well, that's a fine question, but there's a lot more underneath that. That's the transparent side of it. The next question no one ever thinks through is, what are your real incentives here in this, right? If it's, if you're a wealthy individual and someone's trying to get you into an idea, they're talking about what they know best, probably because they want to show you they're smart and they want to be included in it. They may not be trying to get you rich, or they may be trying just to show they're smart. If you're working with, let's say, one of the investment banks, and I'm going to just use Morgan Stanley because that came top of mind. I don't think anyone's affiliated with Morgan Stanley in the room, but they're all similar, right? They are not trying to maximize your performance. They're trying to ensure that they're never really wrong. Because the day that they're really wrong and they bet against the crowd, you're going to fire them, right? So, as some of you know in the room, I've been buying some Chinese equities, and whether you like it or not, I'm certain there are not investment banks that are pitching that. Because the noise is so loud about how wrong it is to invest in that country that if they got that wrong, they'd be standing out on a ledge. Now, if they told you to double down on the tech stocks, well, everyone believes that. That's an easy one to sell. They may or may not be wrong, but they're ensuring they don't get it wrong very much. Great. All right, let's skip this one in the interest of, well, all right. This is framing. This is what everyone's intrigued, right? Look, the problem with the internet, ChatGPT, all these tools, is they're getting really good at tricking us. They know how our brain works, and they're inferring it backwards. Everyone's going to talk about that. But if I give this to you, everyone in the room is going to go, oh, this is a great idea, right? I got a vaccine that could save, 200 people's lives. You're like, in. Now, if I just frame this a different way, I could say, we've got this vaccine, 400 people are going to die. You might be like, I don't know about that one, right? Just a simple difference in framing. You're going to think longer about that second story. So really listening for the framing. Now, I don't think anyone's in private credit here, but I want to talk about how the private credit managers are framing the story for you. And this is the most popular asset in the world right now. The most popular. All the pitches are the same. My team, Kyle, I don't know if Jeff's in here yet. Kyle, Jeff, Paul's heard hundreds too. Here's what the pitches all sound like. We're taking lending share from the dumb banks, right? Which has not been true, by the way, in 10 years. Banks have been growing their loan book too. I don't know who the heck they're lending to, but it's not from the dumb banks the last 10 years. We expect to return double digits. That's because they just want to double all the other numbers in your head. So treasuries are at 5.5, they do double what treasuries do, right? We lend at 800 over treasuries. Okay, we'll get to that one. And then we haven't had a down year in 16 years, right? Well, we haven't had a real recession in 16 years either, but that's whatever, right? They just started their business 16 years ago. So here's the math they want you to do, and I won't, unless people want to get through this math, the carries, the returns, levered, management fees, you get to 11.2% return. So everyone walks out of a meeting with a private credit manager, and they have some number. We have some that are in much higher than that, right, Kyle, when we do this back-of-the-envelope math. Now, Kyle and I ran a firm where we tried to understand and score credit, and here's what we learned when we scored credit over time. CCC companies, on average, lose about, 300 basis points of loss over the business cycle. But that business cycle happens all in 1 year, and the other 9 years look fine, right? So let's just say we applied outside view, stopped the framing and did our own framing, and just said this. First question, who in today's day and age is borrowing at 13%? I run a small gym, and we're borrowing at 4.5%, 5%, right? CCC credit can be borrowed. What's CCC at today, Kyle? 900 tops, right? So 900 treasuries are at 5.5, so that's 4.5 over, right? So they're lending to people way above. These are not stable companies. No one in their right mind borrows at 800 or 900 over treasuries. So I just did the math and said, what if this looks like CCC over time? These are not CCC companies. I know they're rated at weird ratings. They're nowhere near that. But let's just say, let's disbelieve for a second, and they lost 300 over time. And so you do the math, and you get to 600. Just if they lost a little bit, you get to 640 basis points. That's not a hard framing to do. Now, what my partner at Twin Focus informed me of, he's one of the, I think he's, Paul, I would say he's the best tax attorney in, at least in Massachusetts or in the globe here. And he said, you know, Dave, you don't understand how the fee structures work. If you're a high tax resident in Massachusetts or California or New York, your after-tax returns on that 640 are less than 100. Right? So this is an element of framing and understanding what everyone's now. The investment banks love this because part of that 400 basis points management fee actually gets kicked back to them. They don't call it a kickback, I would. So when you're making your advisors really understand their framing and their motives. The last topic I'm not going to go into deeply here because I've asked Evian to really explore how the conscious and unconscious mind works together to really take over your critical thinking, much like the video we had from Spock and Captain Kirk up front. I just wanted to summarize it here. These are some, Evian's going to get deep into this. Here's a summary. Just understand that you're human. Don't fight it. Just make sure you know that you are human. You're going to do human behaviors. You need a checklist to counteract those human behaviors. You need an ability to think from all angles. This inside view versus outside view is really important. Obviously, having a good team, but more importantly, where the incentives are aligned with yours. And then, as Evian's going to discuss this, I wanted to spend a minute on what I am building next. And Henry and I have been working on this, I don't know, Henry, for about a month. And frankly, I'm going to need some help. All right? This isn't something I've ever done before. But my thought on the world is that because of framing, because of the fact, as my partner said the other day, Wall Street's not in it to make you money. They're in it to make themselves money. So the problem is we're setting up for a generation of people who have invested more and more of their wealth. The amount in equities today is the highest of all time relative to people's wealth, and they're making poor decisions. This shows the returns over the last 10 years. The black is retail, and the blue is the S&P, with the exception of the SPAC craze. That was in 21, right? That was the meme stock craze. 9 out of 10 years, retail investors are lagging by staggering numbers. 400 to 500 basis points a year. You take 400 or 500 basis points over 10 years, that's a doubling in your money. Now, to make matters worse...
Okay, is that worse than institutional investors? They're long-only?
I mean...
I would think...
No, I mean, the institutional long-onlys are, 75 basis points net of fees. It's not as bad, right?
It's still bad versus the index.
Absolutely, right? And so this is, but what are we, 30 years into Bogle saying everyone should index, right? Warren Buffett says everyone should index, and yet people want to gamble on their own, right? And so it's not working, right? The way we're communicating is not working. You can say this, but people have not come to the right conclusions, in my opinion. This was from J.P. Morgan. So J.P. Morgan studied the behaviors of individual investors. And for all the women in the room, which there are not many, women make better investors. They just do, right? The worst investors, by far, are people in the lowest decile of income and men under 40, right? I have 3 teenage boys. Damien, you're past that, but we're rash. We make decisions. We believe we can conquer the world. All really important when you were on the plains years ago trying to protect your tribe. Really crummy attributes if you're trying to save for the rest of your life. And so I'm early in the stages of it, but I think the website will be up shortly. I didn't attempt for anyone to read the words because it's up? It's up. There we go. It's up. But I want to think of this as a think tank on how we could influence and really stem this tide of Wall Street framing things in a way that are in their best interest but not ours. What questions do you have for me today? Or we have a couple minutes of questions. Great. questions or observations from what I've said? Jerry?
How are you analyzing how Wall Street's framing things in a way that adds value to you?
I think that's an incredible rubric. I think the first thing I would get to, right, is do I even understand what they're saying? Or am I just following them because I want to like them or they've done something smart in the past? You know, one of the craziest things that I still can't believe how often we see this, Paul, is that, you know, the clients that Paul and Wes have brought on are some of the smartest, wealthiest people in the world. And yet, when you talk to them about how they made the decision, a lot of it sounds like, well, he told me about this one, it really worked. Then he told me about the next one, it really worked. And so I'm going to go in the third one, right? Not really analyzing from the start, which is like, well, if you invested in venture capital in 2008 when the world was trading at 8 times earnings, and now it's at 23 times earnings, you probably made money. So let's take a step back. So I think it's, you know, really trying to be very specific about, you know, what the agendas are in the framing. I haven't figured it out.
David, have you read the book Super Communicators?
I have. What?
You recall the story from it about the doctor who was for decades trying to convince his patients that if they were diagnosed with prostate cancer, they didn't need an operation because prostate cancer would something else would kill them first. But he would bring all the data out, show it to him, and none of the data would. Still, 85% of his patients would say, "Thank you. That's very clear. I will have the operation."
Yeah.
Do you remember that story?
I don't remember the story, but like that's it.
So the
right?
point was that he finally figured out, I need to figure out what their emotions are around this topic, and I need to speak emotionally to them, not with data.
Yeah, 100%. Evian's written a book on that. I love it. Yeah.
I would almost question, you know, we're in a room where people are comfortable with investing. I would almost argue that the masses don't even have fiscal or proper fiscal management. They don't even think about investing. They're so far in debt
Yeah.
that investing is the furthest thing from their mind, and financial education should precede oftentimes.
Yeah, and there are a lot of work on that. Lena and I have already talked about it with the school he's starting. So I think it's really important. Yeah. This is exactly the conversation. Where are you? This is exactly the conversation we had 3 months ago, Leno. So, yep. And this is just to toot Luna's horn here. This is with the school he's starting. He reached out to me and said, "I'm worried my kids will never understand how to make financial decisions, and we need to start in high school." Right? So, you found a covert.
Even something as basic as Rich Dad Poor Dad.
Yeah, absolutely. Great. Adam.
I mean, I did work in Morgan Stanley for a long time.
Oh, that's right. I'm sorry. That's okay, Adam. You're not insulted. My brother works there, Adam, too.
We compete against them now, and it's good for us. But I guess I'd just say, you know, I don't think you could do natural language processing while the work. Like, you could start getting really scientific about what people are saying and everything. I would just say most of the people, if not all of them that are pitching things, don't know that what they're pitching, it's unintentional.
Yes.
Right? And so if you're going to kind of read in their words, do something scientific about it, you have to, I think most of the people pitching stuff aren't aware that they're pitching something bad.
There really are very few bad people. There once in a while there's a sociopath, but the people selling to you believe.
They believe they have skill that has value. They believe what they're pitching is helpful, and it's hard to contend with them.
Correct. Like a good political advocate. Neil, last question, then we're gonna go to the panel next.
So you talk about incentives driving behavior. So how do you incentivize people that you want to get to in terms of making that decision, investment decision, to change their behavior? So we can talk about it, and we probably all go back to the same way of investing in for retail investors. What is the incentive to get them to actually do this? So you have to build sort of an example of decisions they've made that or behaviors they've done which have led to bad outcomes, and those that lead to good outcomes. So I think that's going to be one of the.
I think that's a life's work, Henry. Let's put that down and answer it. We're going to go because I can't answer it yet. We're going to the panel next,